Welcome, NK Singh here. I'll just give him a brief introduction of NK Singh, as he's called Nandu Babu in the fraternity. Comes from a very illustrious family in Bihar. He taught economics before he joined service, so he's a well-versed economic hand in the government for a long time. He has worked extensively in Commerce Ministry in late 70s, 80s, and even Bihar government, Bihar cadre IAS officer. And he's senior to, I think, Principal Secretary to Prime Minister also, I guess.
Oh yes.
Yeah, so he's senior to Principal Secretary to Prime Minister. He has served in various capacities.
Yeah.
So, and the one thing, that anecdote somebody told me, and he may correct me if I'm wrong, that when in Bihar, late 80s, was the first time trying to push industrialization in Bihar, so he went to Japan. He became a controversy in state assembly. But so he's always trying to get industry, economy, and all these things. Very passionate about that. So no wonder the government has tried to leverage his services. He was, before being made the chairman of the 15th Finance Commission, he headed a committee which laid a guide on fiscal responsibility, and it was his committee which said that the 50 basis point, there is a room you can do if there is a situation demands. So the government did not use the entire flexibility he offered, but yeah, it shows the trust the government reposed in him in giving guidance to broader economic policy making. So the format is that you can start with an opening remark, and then the floor will be open to question. People are here from Indian Express and also Financial Express. And if you wish to keep anything off the record, you can tell us. We'll keep that part of the record. So,
fair enough. So you want me to speak? Use this mic? Or
no, use this mic. Yeah. It will be recorded. You just.
Well, thank you very much. Thank you for this opportunity to come here. I didn't realize you had shifted your office. I had been in your earlier office, and this allows me the opportunity for the first time to come to your new office in some sense. And thanks also for those very warm words of welcome, including the fact that my working in Bihar and so on, and the fact that for 5 years I was in Japan, which you mentioned per se here. But in the central government, yes, it is true that I did spend an enormously long time in the Ministry of Finance with successive finance ministers and the regime of successive prime ministers. And of course worked with Mr. Vajpayee as Secretary to Prime Minister before moving to the erstwhile Planning Commission. And then of course my stint in the Rajya Sabha as a Member of Parliament with the Public Accounts Committee and again the Committee on Finance, and then now this FRBM committee which you mentioned, and currently of course the Finance Commission, which is the new thing. So broadly speaking, let me say that as I look back in a certain sense from the fact that my first encounter with India's recent problems was when I entered the room of the former Finance Minister, Dr. Manmohan Singh, in June 1991. And he had just become the Finance Minister, and I was looking after the fund bank division, so to say, which was at the heart of trying to negotiate agreements and arrangements with IMF, World Bank, etc. He told me that we're going to have a new India. We will change the face of India. We will brush aside under the carpet all rules and regulations, and that these changes will be really very radical. At that time, I had no idea that he was talking of the budget, which was going to present in 1991, which did substantially to open up the Indian economy. Now, since that time, And now we have certainly traversed a long distance in the economy. We are very well poised. Our macroeconomic framework is today strong and stable. And our growth rates are may not be touching what is our potential growth rate, but certainly our growth rates are very, very and significantly higher. Fiscal deficit is in check, current account deficit is very modest, inflation is under control, you have Monetary Policy Committee. This government, I must say, has acted with huge responsibility on the overall macroeconomic framework. I can't remember of any government which has demonstrated such an abiding commitment to a stable macroeconomic framework and anchor as this present government, because if you look, Ravish, at the history of India's balance payments crisis beginning from 1980, let me begin with, or even go back earlier, the occasions when India has gone to IMF, World Bank and others to seek balance payments were always preceded by 2-3 years of fiscal profligacy. Now that's something, a lesson which was learnt and forgotten, It has been a flip-flop story, including the fact that when the first FRBM was enacted in 2001, for a few years we adhered, then we again strayed off. And I think that the fact that this, as soon as this government came in 2014, one of the things which the Prime Minister clearly demonstrated is that he believed in financial rectitude and he believed in a stable macroeconomic framework. And as you can see, in the last 4 years or so, he has shown his strong abiding. So India is a much more different place. It's more open, growing much faster, it's growing with greater responsibility. States are an increasingly growing partner in a federal compact. I don't only mean the GST Council, but by the way, one should not really underrate the importance of the GST Council, because it's the first successful federal experiment of how to work together on important things like constitutional changes, changes of tax rates, etc. And it does set in store the possibility that you can leverage the states and secure better outcomes. So a working fiscal federal compact is, I think, one of the lessons also in the last few years. And I think it has also shown a capability to try and deal with some of the more difficult issues on private investment, on bankruptcy, on, for instance, much quicker resolution of problems, on focus on ease of business, and getting states to become partner. And this is a new kind of a phenomena which we are seeing in the recent years. So I think that I come to the Finance Commission at a significant, a challenging juncture, but at the same time in the backdrop of by and large, the country having pursued a policy of a stable macroeconomic framework. I stop here.
I'll start with the politics. Your predecessor, Y.B. Reddy, came from Andhra Pradesh. In Andhra Pradesh, yesterday created a political earthquake of sorts. As 15th Finance Committee chairman, do you think what happens to the special needs of some political developments, and can that be accommodated in the framework as it stands today? The kind of demands being made by Andhra Pradesh, or at one point of time being made by your own party, of which you are a member, JDU. So is there a scope where the Finance Commission work around?
Yeah, let me answer that. It's just a complex question. Let me first of all say that the Finance Commission's work must emanate and must end with its obligations contained in the terms of reference. The terms of reference are determined by the President on the advice of the Council of Ministers. But in the Constitution, there is one more proviso, which says that any other issue referred to the Commission by by the President. Now, in the present, as is the case with earlier finance commissions too, in the present case, a number of issues have been referred to us. They fall into two baskets. The first basket is those things which the Commission may like to bear in mind while making their recommendation. These, for instance, include the success achieved on population replacement rates. These include the flagship programs of the government. These include suggesting a fiscal and macro roadmap, a consolidated fiscal strategy, which means both the center and the states. It means a whole lot of other things on those issues which we need to bear in mind. Then there is a second category which says that we could consider monitorable performance criteria in respect of states, which could deal with, for instance, ease of doing business, promoting labor-intensive industries, promoting sanitation, ending the practice of open defecation, success achieved in flagship programs and so on, which if we can evolve monitorable performance criteria for us to consider whether we would like to give incentives or not. So these are the classic functions and added functions of the Finance Commission as given to us by the President. So the obligation of the Finance Commission is to discharge this and to give the recommendations on vertical, horizontal distribution under our to local bodies, panchayats and Zilla Parishads, and to consider some of the issues which are mentioned, to also suggest or not to suggest grants in aid to states as a general category, and also look at performance monitorable criteria. One of the interesting measurable performance criteria is the extent to which states have been indulging in populist expenditure. We are, of course, trying to find out what this would mean, what populist expenditure can mean, but we will find some of these issues out. So now within this framework, where does this business that you have just mentioned of the Andhra's demand of a special category status figure or doesn't figure? Now, first, I think to some extent, in all fairness to the previous commission, there was what they said was not so much that they abolished the special category status. They said that it was not really appropriate to have categorization of states into special category, non-special category, and they should be treated in a generic way. And states which needed special attention, this could be addressed through the other measures and other means which the Finance Commission has at its disposal. So there is where that rests. The special category issue is not and was not a specific terms of reference of the earlier Finance Commission, but it did pronounce on the fact that these kinds of categorizations into different kinds of baskets was something which has outlived its utility and was not the most appropriate path forward. And this is what I find from the newspapers. The Finance Minister has said that in having accepted the recommendations of the 14th Finance Commission, which to eliminate all these categorizations, he has gone by what the government has done in accepting in totality the recommendations of the previous Finance Commission. Therefore, that is the end of the matter.
No, you marshal all your knowledge of the government system and information and inundated us with facts and information without answering our question. Let me frame it differently. You are the chairman of the 15th Finance Commission. Yesterday's political developments have two aspects. The central government is using 14th Finance Commission recommendation as a shield. The TDP government, one state government, is using 14th Finance Commission recommendation as a punching bag. So how does the chairman of the 15th Finance Commission look at this tension between federal government and the state government on issues of resources and demands for special attention?
Well, our job is neither to provide the shield nor give the basis for a punching bag. So it would be somewhat of an exaggeration to suggest that the central government is using this as a shield, because having accepted the recommendations of the Finance Commission in totality, one of the recommendations was really eliminating all these artificial categorizations. And by the way, the recommendations of this Finance Commission was received to the best of my knowledge in December, when Mr. Modi had come to power in May. And so for this issue to have been raked up now after so many years, really, I mean, I don't know. I mean, issues can be raised at any particular point in time, but I think it may be a bit of an exaggeration to suggest that the government is using it as a shield. The government is just stating the facts. And the fact is that the previous commission said that these categorizations are artificial, and that along with the other awards of the Finance Commission, it also accepted this particular recommendation. Now let me also clarify, demystify one particular thing. Having also worked on the Planning Commission, let me demystify that what does a special category status mean, and how was this, what is the animal called the special categories? It has only two features. One is it gives you a tax break for a particular period of time. Typically it's about 10 years with a sunset clause, namely freedom from excise and freedom from the payment of income tax and corporate tax. Therefore, it becomes a way of attracting more industries who do not want to pay the tax, go and locate there. The other thing is, what it does is that in respect of centrally sponsored schemes, central schemes, the normal feature used to be 60% used to grow, 70% used to go as a grant, 30% used to go as a grant, 70% as a loan, 30% grant, which got changed to 60% as loan and 40% as grant. In the case of centrally sponsored schemes or special category states, 90% goes by way of grant and 10% by way of loan, which of course enables, therefore, A, the state to receive more resources, B, gives them a greater headroom, fiscal headroom, to be able to contract debt. So these are the two features of what is called special category status. Originally, it was conceived for J&K. It was extended to the northeastern states. Then Mr. Vajpayee, in a public meeting, announced it for Uttarakhand and for Himachal. And there it stayed. And it has been extended beyond the sunset clause. So I think that the 14th Finance Commission, all it said is that instead of these artificial categories, you cannot do it retrospectively. It couldn't have done it retrospectively, because many of them who are enjoying the benefits and have set up plans and etc. on the basis, they couldn't have been penalized retrospectively. So they are allowing the sunset clause to kind of wear out if it's not extended. But it did say that further categorization into these kind of categories was not something which was appropriate, and this should be dealt with by providing assistance in other forms. Now, you have asked me the direct question, what does the 15th Finance Commission intend to do? That is your question. Let me give you one point. I intend to address my terms of reference, and this is not part of my terms of reference. But one of the things which is part of my terms of reference is certainly to look at equitable regional growth, which means that, like all finance commissions, which look into the question of the extent to which some states are well below the average mean of national per capita income, on Human Resource Development Index, or in terms of infrastructure, they have received special attention. And this special category state in respect of very backward is one of the means for enabling them to catch up with the national averages. So you could do it that way, you could do it in other ways. But the issue really for us is not special category states. The issue is to address the terms of reference. One of the areas in the terms of reference is fostering equitable and balanced regional development, and certainly we will look at the levels and index of backwardness of different states.
Hello, yeah. No, so what you are basically referring to is there is no question of obviously tax breaks and whatever 10-year holidays and all those things coming up. So there is no incentive for me to go to Kutch or to Kangra or to this thing to set up based on tax breaks. Right, and same, what you're saying is that everything will become whatever 60-40, there will be no. So why should anybody, any investor today go to these places? I will prefer putting more and more investment in same Gujarat, same Karnataka, same this thing, and within Karnataka probably more Bangalore than Belgaum, you know, and within Gujarat probably less of Kutch and more of Ahmedabad, Mehsana, that particular corridor. So what does one do in this case? I mean, can we just say that no, let us leave everything to the market forces and this kind of a thing?
Good question, very good question. Let me just make two comments. First comment is that I did not say that we will not consider or there is no scope for considering any of that. We have the mandate and every authority to revisit anything which has been visited earlier. And this commission is not bound except by the terms of reference which have been referred to us. So it is perfectly up to us what we wish to visit and revisit and come to such conclusions as we consider appropriate. So that I must disabuse you on that. Second, I think your question is a more fundamental question. Given the fact that if you do a dispersal on levels of backwardness, there are some states which fall way below the national averages in terms of well accepted characteristics of backwardness, in terms of per capita income, number of schools available, road density, rail density, and index of both physical and social parameters. They fall well below the national average. So what should be done to really basically, this is the more fundamental question. So I think that frankly every commission has given a certain weightage to try and ameliorate the backwardness of states which have fallen well below the national averages by way of much higher devolution. But historically, all 14 Finance Commission have given high weightage both to population as well as to the index of backwardness. So instruments are available in terms of direct devolution of additional financial resources to the states, either by way in our devolution formula or in terms of when it comes to grants and aid to make up that, we can use the criteria. So it's not as if that unless you do that, there's nothing very much which you can do to emulate the condition of the state.
These direct taxes as a percentage of the total tax revenue of these central and states put together is around 35% only now of the total tax. So whereas in many other countries like in Europe and all, it is much higher at 70%. So earlier, one reason why higher devolution was given to states was the direct tax, their share was much lower. So now that the GST has come and there is also generally a shift towards indirect taxes in recent years. The last 2 years you see more indirect taxes, the indirect tax growth coming much higher than the direct tax growth, and the indirect tax share as a total tax is increasing. So in that context, do you see a kind of reorganization of the the devolution criteria? Also in your terms of reference itself, you have been given much weightage has to be given to central sector schemes. There is also the center is almost regretting that they have given a higher devolution to states under the 14th Finance Commission, because they have said it has affected our revenue already. So do you see a context of the devolution changing in this because of this?
First of all, I haven't reached any such conclusion, and that historically India is one of those countries where a very disproportionate part of India's revenue have come from indirect taxes, and part of the problem of those indirect taxes, and that really speaking, a developed economy should move away from indirect taxes, which by definition, you know, are regressive, because the incidence of that does not differentiate between a rich and a poor person. And that we should move over to greater reliance on direct taxes. Now, the first thing is that GST now is the big elephant in the room, and that has taken care of all excise, VAT, and all that has got subsumed in it. So that will become operational in its own way. So that part is over. That leaves on the indirect tax side, that only leaves that only leaves customs duty. On customs duty, as customs duty over a period of time have to calibrate to long-term global averages to promote international trade, and countries can go through a process of some change for 1 year or 2 years, etc. But over a period of time, reliance on customs will also come down, because the gains will come from a much larger volume of international trade than rates of customs duty. Yes, I completely agree with you that you would need to move towards greater reliance on direct taxes. And direct tax to GDP really needs to substantially go up. Now, the big problem there has been exemptions and enforcement. To look at the number of people who are declaring incomes of more than 1 crore for India as a whole is a laughable really number. And I say this with some remorse, because I have been Revenue Secretary myself for several years. And it is true that our ability to be able to capture, but all that is changing, because technology is doing a fundamental change. And also I think that the spillover effects of the GST will also, the beneficial effects will come on direct taxes, because as a huge number of people come on the net on the GST net, many of them who are not paying direct taxes will also now be paying direct taxes. So it will also have a beneficial impact. The GST net will have a beneficial impact on the direct taxes. But the exemptions on direct taxes have to come down very significantly. At the same time, in that exemption is a complex issue of the fact that the entire agriculture sector is outside the tax net. And even though agriculture may constitute just 12% of GDP, if 45 to 50% of people are still deriving livelihood from agriculture, you are ab initio leaving out a very high percentage of people. Now you can take the view that they are poor people, etc., etc., but whether the view that every agriculturist is a very poor man, because is something which we will need to I think but that's a state subject under the Constitution, but that is again exempt. Then the exemptions are, the enforcement quality needs to be dramatically improved, and we need to use technology, which we are now using much more extensively and intensively, this 360 degrees profiling, capturing all the data, the big data on the not only via the GST but otherwise. But I think that the path forward clearly is to substantially increase the direct tax to GDP as we have now calibrated the resting point on the indirect taxes. By the way, service tax, which didn't exist some time ago, is now a very important ingredient too. And service tax is showing the highest amount of buoyancy, which is inevitable in an economy going through this particular phase of progress.
The Regulator has proposed a multi-dimensional index for backwardness of states. So that index also we can use, if the special category state is not, that tag is not given. Alternatively, you can have, as you suggested earlier, this multi-dimensional index to find out the states which are very low in below national average in terms of.
As long as you're not suggesting that I was responsible for giving inputs to the Raghuram Rajan Committee report in pursuance of something which you said, that at that time I belonged to a political party which believed greatly in special category. But yes, I have seen the Raghuram Rajan Committee compilation of index, and at the bottom of that index are the states of Odisha at the lowest, and the next to Odisha is of course Bihar. But we will be looking at fresh data, and we will be getting some more studies done on the index of backwardness, robust index of backwardness by doing simulation and econometric analysis to arrive at some conclusion, because it is no-brainer that all finance commissions in the past have looked to index of backwardness as one of the trigger criteria for purposes of devolution.
Is there a case to revisit the 42% number to peg it at a realistic level, along with a rider that the centre doesn't resort to surcharges and cesses that unfairly keep the states on an uneven peg when it comes to the divisible pool? Is there a case for that?
Nicely loaded words. so nicely loaded. Let me say that just three very brief comments. First of all, is there a case to visit the 42% or not? I don't know whether there's a case or not. That's a conclusion that the Commission will have to reach at the end of its deliberations. But yes, it is part of the terms of reference, and this 14th Finance Commission's award itself is part of the terms of reference. We will certainly need to examine and consider it. Also, we will need to examine the overall framework, where you are right, because the 14th Finance Commission's recommendations of this 42%, by the way, it's not 42%, it's much more. I'll just explain that. Certainly, those recommendations, in the backdrop of that, was this rationalization of the centrally sponsored schemes. So the idea really, the philosophy was that you don't micromanage, you give them much higher resources, allow them to do whatever they want to do with that resource. Why do you want to suggest what you want to do or not? Now, shortly after that, of course, you know that there was the Shivraj Chauhan's report on centrally sponsored schemes, which categorized them in three categories: core of the core, central schemes, and the optional schemes. In truth, what has happened is that a lot of centrally sponsored schemes are still continuing in one form or the other, with varying proportionality in the sharing of the financial burden. And that the index of happiness on centrally sponsored scheme has certainly not gone up exponentially. Nobody seems to be happy. States are unhappy that you have changed the financial burden sharing formula. Central government is not very happy because they say that we are continuing with that burden, but we don't have the resources to be able to do so. So I think if you compile on the index of satisfaction on the centrally sponsored scheme, that is something. Yes, one of the things that the Commission has to do is, to discharge its terms of reference, is to look at the award of the 14th Finance Commission, which entails looking at the 42% formula, and to arrive at such conclusion which it considers and believes is appropriate. By the way, why it is not 42% is that I think it's not come out so much in public domain, that this 42% leaves out the fact that you are also giving separately for panchayats, for local bodies, and without Parishad. And the last Finance Commission increased that very substantially. And if you add all this and the grants indeed under Article 275, it comes to close to 47.5 or close to 48%. So, because panchayats are in the states. Now, you asked a question on cesses and surcharges. Yes, people have written to me, and some states have written that cesses and surcharges have been kept out of the divisible pool, and this is kept only by the central government. This is, if you ask me, a legal question and a constitutional question. But since cesses and surcharges are so much now in public domain, we will certainly get an independent study and legal opinion on that one.
It has been too much of Finance Commission and your brief, but you've been a very long-standing North Block hand. I would just like to pick your brain on what's happening in banking sector. The recent PNB fraud. Do you think who is at fault? Don't you think the regulator has also, in a way, found on the wrong foot, that it was not vigilant enough?
Well, you know, the very technical reason why this PNB fraud took place is a very simple one of the mismatch between the use of SWIFT with the core banking functions, and being done over a long period of time, it repetitively brought about this. And the fact that, fact that 5 audit entities within the bank, the internal audit, the external audit, and something, there are 2-3 other audit functions within the bank. All these 6 audit functions within the bank couldn't really place their hands on this kind of an irregularity, doesn't speak well of the governance ethos of the bank in question, and may want to raise questions on the governance fabric of some of the other banks who have also apparently got affected. Your second component is the regulator. Now, the banking regulator, we all know, is the Reserve Bank of India. And the Reserve Bank of India, following the Narasimhan Committee 1 in 1991 and Narasimhan Committee 2 in 1998, had suggested that a separate entity be created within the Reserve Bank itself, which is going to have domain knowledge and expertise to be able to do the kind of detailed supervision of an ombudsman, and a lot of on-site inspections by the Reserve Bank. I think that, in my view, the path forward is twofold. One, to fully implement the letter and spirit of the Narasimhan Committee report in having a robust entity within the RBI with adequate manpower and on-site supervisory skills. And second, to keep your mind open on whether or not you require a super regulator and who that super regulator would be. Finally, I think that one of the areas in which India has been very deficient has been parliamentary superintendence and parliamentary oversight on the working of regulators. Look, I mean, how many occasions does the governor of the central bank receive an interactive meeting with parliamentarians? Zero. He may be called to give some deposition in the Public Accounts Committee on demonetization. He may be asked by the Parliamentary Standing Committee to come in the light of the PNB. But this is not regular interaction. All over the world, you have a specialized, take the case of US, you have a specialized Senate committee, you have a specialized committee in the Congress. So what we have done is, as we have traversed the distance on creating regulatory entities, we have not allowed our regulators to face the burden of parliamentary superintendence on regulators. Because the issue of who will regulate the regulators, when you create an independent regulator by a separate act of parliament, and if parliament does not exercise superintendence functions on some way on the regulators and oversight, you have created a no man's territory. And we need to learn by the best international example of, let us say, creating 1 or 2 parliamentary committees which really for the purposes of interaction with regulators. The financial sector has the maximum number of independent hybrid regulators, but there are others. For instance, there are electricity regulator, there is the telecom regulator. So, parliamentary superintendence over the independent regulatory functions, in my view, is an area of parliamentary reform.
I'll take this position to ask the last question before you wind up. And I reckon you are going to start from Arunachal Pradesh, but I'll come to second A. What will be how you are going to face when you visit Andhra Pradesh?
Well, I should expect that Andhra Pradesh, first of all, Arunachal Pradesh, we have started from Arunachal Pradesh, and the state government has also suggested that we spend a little time by going to Tawang also, which we are looking at the detailed program given by the state government. After Arunachal, our next state is J&K. We are first going to Jammu. The government is in Jammu in April, and then we'll also go to Srinagar, and we will be visiting other states now. So we're looking forward to our interactive visits to all the 29 states during the course of this commission's work, and not only to meet government officials. As you know, just as keeping in the past tradition, we'll be meeting no doubt the Chief Minister, Council of Ministers and so on, but we're meeting all political parties, all stakeholders, panchayat representatives, municipalities, academic bodies, and it's a fairly wide-ranging consultation that the Finance Commission has in terms of the independence of judgment to which it must arrive at before it makes its recommendation. Now, what welcome do I, or what unwelcome am I expected to meet in Andhra Pradesh? We will cross the bridge when we come to it. I mean, I expect that the memorandum would be for us to revisit some issues which have been visited earlier. We will see, we will take into account all submissions which are made to the Commission. It is, after all, our principal obligation to take into account all submissions made to us, either on behalf of the states, on behalf of the organization, or on behalf of the Finance Ministry or the central government. We will view all these as submissions made to the Commission to arrive at what we believe would be appropriate conclusions. And the independence of the Finance Commission is something that I definitely want to underscore.
Thank you very much for your time, and it was a learning experience for all of us. Thank you very much.
Thank you very much. Thanks.